Click on the subscribe button below to access other helpful videos from this channel. Do yourself a favor and check out the description box below. The example used in this lesson and other useful study notes can be downloaded or printed from the link in the description box. Also, you can click on the video timeline to see the chapters or sections that this video covers. The whole process for calculating personal income tax is a lengthy one, so we have split the income tax calculations into 4 steps. In step 1, we will discuss how to calculate the annual taxable income. With step 2, we will use the tax tables to calculate the annual tax rate. Then, in step 3, we will explain tax rebates and medical tax credits in order to calculate the annual tax payable. Lastly, step 4 will involve dividing the annual tax payable by 12 to get the monthly tax payable that is shown as Paye on a payslip. This lesson will focus on step 1 only. We are going to continue using the example from Harry's payslip to work through the steps. Before we get started, you must take note of this. Even though we are doing the income tax calculations step by step, don't lose sight of the end goal. We ultimately want to calculate the monthly PAYE that is shown on an employee's payslip. Now, we know that the PAYE shown on the payslip is the income tax for 1 month only. But when we do our calculations for step 1, we need to work with the annual taxable income because the tax tables are based on annual tax rates. So we will start the process with the annual taxable income so that we can use the annual tax rates from the tax tables. And we will continue to work with annual amounts throughout step 2 and step 3 of our calculations. It is only once we get to step 4 that we will take the final amount for the annual tax payable and divide it by 12 to get the monthly PAYE that will be shown on the payslip. Now, you must have realized that before the business can complete the payslip and calculate the employee's net salary, they would already need to know how much to deduct for the employee's income tax. So even though we revised payslips before getting into these income tax calculations, we are now going back to see exactly how the PAYE amount that is shown on the payslip is calculated. Let's start by understanding what is annual taxable income. It is called taxable income because it refers to the portion of your income on which you are required to pay tax. Why do we need to start with the annual taxable income though? It is because the tax rate that is used to calculate an individual's income tax is based on the annual taxable income. And these tax rates have been summarized by the government in the form of tax tables. So in order to use the tax tables, we first need to know the individual's taxable income. Now that we understand why we need to use the annual taxable income, the next step is how do we calculate the annual taxable income? There are two ways of getting the annual taxable income. Number one, it could simply be given to you in the exam. If it is given to you, then you can take this annual taxable income and go directly to step 2 and use it in the tax tables to find the annual rate of tax. But in case number 2, where it is not directly given to you, then you will have to calculate it for yourself. The annual taxable income is equal to the annual gross salary minus the annual taxable deductions. Just take a minute to look over the calculation for annual taxable income. Light bulbs should be flashing in your head right now because these terms should sound familiar. The term gross salary and deductions were explained in the lesson on Payslips. If you missed that lesson or you are still unsure about how to work with a payslip, then you must watch that lesson before moving on. Coming back to the annual taxable income calculation, let's break it down and discuss each term separately. Let's first look at the annual gross salary. In our lesson on payslips, we learned that the gross salary is the total income that an employee has earned for the month. In the examples below, we will be using Harry's information to do the calculations. Once again, remember that we are following all these steps so that we can eventually calculate Harry's income tax that will be shown on his payslip for February 2021. Now, in an exam, you could be given the income that makes up the gross salary in the form of a list. For example, you could be told that Harry earns a monthly basic salary of 30,000 Rand and receives a monthly cell phone allowance of 1,200 Rand. In addition, Harry received a bonus of 30,000 Rand and overtime pay of 1,400 Rand in February 2021. Then, based on this information, you can add it up to calculate Harry's gross salary for February 2021 as 62,600 Rand. Or the information can be given to you in the form of a payslip. Then, using the payslip, we can see that Harry's gross salary for February 2021 is 62,600 Rand. Now, you might think to yourself that because you have the monthly gross salary, all you have to do is multiply it by 12 and you'll then get the annual gross salary. But no, that would be incorrect. Can you think of the reason why you cannot just take the February's monthly gross salary and multiply it by 12 to get the annual gross salary that will be used to calculate February's income tax? Because in this specific scenario, the February's monthly gross salary includes a bonus and overtime pay. If you multiply the full gross salary of 62,600 Rand by 12, you would be saying that in all 12 months, Harry will receive a bonus, and in all 12 months, Harry will receive overtime pay. If you remember our payslip lesson, though, we said that an employee will only receive a bonus and overtime if they have qualified for it. So yes, In February 2021, Harry did qualify for a bonus and overtime pay. But that does not mean he is also going to receive a bonus and overtime pay in the other 11 months. What must we then do to calculate the correct annual gross salary? To calculate the correct annual gross salary, you must only multiply the fixed income that an employee will receive throughout the year by 12, and the other income that will not be repeated in each month must only be accounted for once. So, to calculate Harry's annual gross salary, we will take his fixed monthly basic salary of 30,000 Rand and multiply it by 12 because he is due to receive it in every month. And we will also take his cell phone allowance of 1,200 Rand and multiply that by 12. Because if an employee qualifies for an allowance, then they will generally receive this allowance throughout the year. But we will only add Harry's 30,000 Rand bonus once and his 1,400 Rand overtime pay once, because these are not necessarily going to be repeated in each month and must therefore be treated as once off incomes. From this calculation, we can see that Harry's annual gross salary that will be used for tax purposes is 405,800 Rand. Now take note, if the payslip included a second allowance such as a travel allowance, then this travel allowance must also be multiplied by 12 when calculating the annual gross salary. Now that we have the annual gross salary, we can move on to the next term, which is the annual taxable deductions. Before we move on to the annual taxable deductions, though, do you hear those alarm bells? Good, because we need you to be alert for this next part of the explanation so that you can avoid any confusion later on. You must understand that there is a difference between payslip salary deductions and taxable deductions. We will repeat this. Payslip salary deductions are not the same as taxable deductions. Salary deductions are the deductions that are subtracted from the gross salary to calculate the net salary, whereas taxable deductions are those deductions that SARS will not tax you on. Now, let's go back to Harry's payslip and recap the salary deductions. Salary deductions are made up of the compulsory deductions and voluntary deductions. On Harry's payslip, the total of his salary deductions amounts to 13,344 Rand and 72 cents. These salary deductions were then subtracted from his gross salary to calculate his net salary of 49,255 Rand and 28 cents. So don't confuse your payslip calculations with your income tax calculations. The recap that we just did now shows how the salary deductions are used to calculate the net salary that the employee receives in his bank account, whilst the next section on the taxable deductions will be used to calculate the annual taxable income that is used in the tax tables. Do you see that they are completely different calculations? Next, we are going to look at what makes up the annual taxable deductions. The taxable deductions include pension contributions, donations to Section 18A organizations, and the business portion of a travel allowance. If an employee has any of the above, then SARS will not tax them on it and they will be allowed to subtract it from their annual gross salary when they are calculating their annual taxable income. Now let's get into why SARS allows the above items as taxable deductions, starting with pension contributions. SARS will tax you on your pension lump sum when you receive it in the future at retirement. So, if SARS is going to tax you on your pension contributions at your future retirement, then they can't tax you on it now in the present also. So, SARS will allow you to deduct the pension contributions when calculating your PAYE to prevent you from being taxed on it twice. And that is why pension contributions is a taxable deduction. Next, let's talk about how donations are taxable deductions. The government wants to encourage charitable acts, so SARS will allow you to deduct certain donations when calculating your annual taxable income. To make sure that individuals do not take advantage of this incentive, the donations must be made to registered organizations that meet certain government regulations, and there is a limit on how much can be deducted as part of donations. So, if an employee's donations meet these requirements, those donations can be used as taxable deductions. And lastly, the business portion of a person's travel allowance is a taxable deduction because it was used for purely business purposes and the individual did not get any personal benefit from it. Thus, the individual will not be taxed on it and can deduct it when calculating annual taxable income. To then calculate the total of the annual taxable deductions, we must add the annual pension contributions, the donations made in that year, and the business portion of the travel allowance. Now, you must read the question to see which of the taxable deductions apply to the scenario in the exam. All of them may apply, or perhaps only one of them will apply. To find the pension contribution, you can either be given the information directly in the question, or if a payslip is given to you, then you can find the pension contribution under the deductions section of the payslip. Note that the other deductions on the payslip, such as the UIF, trade union membership fees, etc., are not taxable deductions, and you must not use them as part of the taxable deductions calculation. The only salary deduction that is also a taxable deduction is the pension contribution. Now remember, the pension contribution shown on the payslip is for 1 month. And because Harry makes this contribution every month, you need to multiply it by 12 to get the annual pension contribution. From Harry's payslip, you can see that he makes a monthly pension contribution of 2,250 Rand. And once we multiply it by 12, we will get the annual pension contribution of 27,000 Rand. To determine whether donations apply to the exam scenario, you must read the question to see if any donations were made to Section 18A organizations during the year. From the given information in the scenario, we can see that Harry made donations of 15,000 Rand for the year. Why did I not multiply the donation amount by 12? Remember that only the regular items that will occur every month are the ones that you must multiply by 12 to make it an annual amount. Harry's basic salary, allowances, and pension contributions are regular items that will occur every month, so we multiplied those by 12. But the question clearly tells us that Harry's total donations for the year amounted to 15,000 Rand, and not that he makes 15,000 Rand worth of donations each month. So, just like the bonus and overtime, the donation is treated as an irregular item and will only be used as a once off amount in the calculation. In this example, there isn't a travel allowance, so the business portion of the travel allowance does not apply here as a taxable deduction. If you did get a scenario in the exam with a business portion of a travel allowance, then you would also have to include it in your calculation. From our example, Harry's total of his annual taxable deductions amounts to 42,000 Rand. Hey, now that we have the annual taxable deductions, we can substitute it into our annual taxable income calculation. So the annual taxable income is equal to the annual gross salary of 405,800 Rand minus the annual taxable deductions of 42,000 Rand. This gives us an answer of 363,800 Rand. And this is the amount that we are going to use in step 2 with the tax tables. When writing out the annual taxable income calculation on your exam answer sheet, we recommend that you break up your calculations. Remember, you must show each step of your calculations to earn part marks. So if you have to take into account all the items that make up the annual gross salary and the annual taxable deductions, your calculation is going to be a lengthy one, and it may get confusing if you try to show it all together. So start with writing out the calculation for the annual gross salary. Then write out the calculation for the annual taxable deductions. Now put it together to finally arrive at the annual taxable income of 363,800 Rand. Do you see how we have laid out our calculations? Firstly, it is important to label your calculations. The person marking your matric exam must be able to clearly identify what you are trying to show them in your calculations. Also, take note of our use of brackets where the amounts must first be multiplied by 12 to make them annual amounts. Yay! We have now completed step 1, in where we have the amount for the annual taxable income. In the next lesson, we are going to move on to step 2, where we take this annual taxable income from step 1 and use it in the tax tables. Come on, let's get on with it. Like this video and subscribe to the Educator channel. The more learners we reach, the closer we get to making quality education a reality for all.